Top 5 US companies that beat the S&P 500 every year since 2020. Most investors would be thrilled to beat the S&P 500 even once. Do it 2 years in a row, that's rare. Do it 4 years in a row through a global pandemic, inflation spikes, interest rate hikes, banking crisis, tech layoffs, well, that's elite. Since 2020, the S&P 500 has delivered respectable returns, but in every one of those years, some companies have quietly outperformed it not just once, but consistently. They turned your 1 lakh rupees into more than 3 to 5 lakh rupees in just a few years. And that too quietly and consistently. We're not talking about meme stocks or flash in the pan IPOs. We're talking about companies with real products, real profits, and real resilience. These businesses didn't depend on hype cycles or CEO tweets. They built moats, they generated cash, they executed quarter after quarter. While the headlines focused on tech bubbles, AI hype, and market crashes, these 5 companies kept on compounding, and the best part is, most of them aren't even in your typical tech bro portfolio. They're in sectors like healthcare, logistics, membership retail, and chip design. And yet they have quietly delivered a 20 to 40% CAGR year after year, crushing the index every single time. In this video, we'll reveal the top 5 US companies that have beaten the S&P 500 every single year since 2020. We'll break down what makes them great, how did they do it, and what can you learn from them as an investor. Because in the end, true wealth isn't built in noise, it is built in consistency. Stock number 1, OReilly Automotive, the silent compounder that keeps beating the market. When most investors think about high growth US stocks, they picture flashy tech names. But what if I told you that one of the most consistent compounders over the last 5 years sells auto parts? OReilly Automotive, ticker symbol OReilly, is one of the most underrated wealth creators in the US market. It doesn't make headlines, but it makes returns. Let's look at the numbers. 2020, 3.27%, 2021, 56%, 2022, 19%, 2023, 12%, and in 2024, 24%. The 5-year CAGR for O'Reilly from 2020 to 2024 is approximately 22%, and in 2025, year-to-date return is 14%. Now that's 5 years of consecutive positive returns, consistently beating the S&P 500, even in tough macro years like 2022 when the broader market was down nearly 20%. So what makes O'Reilly so special? Well, it operates in a space most investors usually ignore: aftermarket auto parts. But here's the thing, when the economy slows down, people fix their cars instead of buying new ones. That is where O'Reilly shines. With over 6,000 stores across the US and a rock-solid distribution network, it is the go-to brand for both consumers and mechanics. The business has strong same-store sales, robust free cash flow, and high return on invested capital, exactly what long-term investors want. Most importantly, O'Reilly isn't just surviving downturns, it is compounding through them. While everyone's watching tech giants go up and down, O'Reilly has been quietly outperforming the market year after year, and here is one investor insight about it. O'Reilly teaches us that the power of boring businesses with high-frequency utility. People may not think about car parts often, but they need them consistently in every economic cycle. It is also proof that a company doesn't need to be innovative to be an exceptional investment. Instead of chasing the next hype wave, sometimes the best move is to find a simple, necessary business that just keeps on executing. Now coming to stock number 2, Eli Lilly, the pharma giant that turned healthcare into a hypergrowth story. When we think of pharmaceutical companies, we typically think slow, stable, dividend paying, but not that exciting. But this company has flipped the script altogether. Between 2020 and 2024, this company has delivered jaw-dropping returns. In 2020, 31%, 2021, 66%, next year, 34%, next year, 60%, and in 2024, 33%. That's 5 years of extraordinary outperformance. The result, a 5-year CAGR of over 44%. A level of compounding that rivals the biggest names in the tech can only dream about. So what's behind this pharma powerhouse? Well, 2 words: GLP1 Revolution. The company is at the forefront of one of the most important healthcare breakthroughs in recent decades. Treatments for type 2 diabetes and obesity, drugs like Mounjaro and Zepbound aren't just medications, they are reshaping global health economics. With over 1 billion people globally affected by obesity-related conditions, this is a market that's not only massive, it's growing faster than the most tech categories. Wall Street quickly realized that these drugs were more than just another product line, they were category defining. But Eli Lilly didn't just stop there. They've also built a deep pipeline in neuroscience, oncology, and immunology, making them not just a GLP1 bet, but a future-proof pharmaceutical leader. What makes this story even more compelling is how quietly it happened. While everyone was chasing AI and electric vehicles, Eli Lilly was executing quarter after quarter with one of the most strongest pipelines in the healthcare world. Now, insight here is that this company teaches us that innovation doesn't just live in the Silicon Valley, it can also come out from healthcare breakthroughs. And anything which has the potential of solving real global problems at a scale can deliver returns just as dramatic as any other tech company. What sets LLY apart is basically its ability to combine long-term R&D discipline with near-term product success. It's also a reminder that the timing the hype isn't as powerful as owning the execution. For investors, the takeaway is clear. When a company is dominating a growing category and reinvests for the future, it doesn't just grow, it compounds. Now coming to stock number 3, which is Costco, the only retailer where people pay to be loyal. Now this stock is basically the Visa and MasterCard of the retail shopping world. Every year, millions of people around the world do something unusual. They pay a fee just for the privilege of shopping at a store. That store is Costco. With over 130 million members globally and a renewal rate north of 90%, Costco has built one of the most powerful loyalty models in the modern retail. And the market has rewarded that discipline. And here is how Costco outperformed between 2020 and 2024. First year, 36%, second year, 51%. Third year was a downturn of 19%, but it was followed by a upward of 49%, and then the next year with 39%. Even with a pullback in 2022, Costco recovered fast and strong, posting a 5-year CAGR of over 28%. Now, what is driving this level of compounding? It comes down to 3 things. Number 1, membership economics. Number 2, price trust. And number 3, operational consistency. Unlike traditional retailers, Costco generates a large portion of its profit from annual membership fees, not product markups. This allows them to keep prices aggressively low, build a kind of pricing trust with consumers that's rare in today's market. Customers know that they are not being upsold, they are being rewarded for loyalty. That pricing strategy combined with bulk-driven inventory efficiency creates both scale and stickiness. And during inflationary period, it becomes a massive advantage. Costco also owns most of its real estate, controls its supply chain end-to-end, and expands carefully, only opening new warehouse where demand and efficiency make long-term sense. Now, Costco teaches us the value of recurring revenue in non-subscription businesses. Its ability to extract loyalty before a transaction happens is a masterpiece in brand trust and margin protection. For investors, this is a reminder that the great business don't just sell, they build relationships that last decades. And those relationships show up in the cash flow, in the renewals, and on the stock chart. Now coming to stock number 4, Cadence Design Systems, the brains behind every major chip that you use today. Every time a new AI chip is built, whether it's by Nvidia, Apple, AMD or Intel, there is one company working quietly behind the scenes. This company is none other than CDNS. Cadence doesn't just manufacture semiconductors, instead, it builds the mission-critical software used to design, stimulate, and verify the chips before they ever reach the production phase. And that makes it indispensable to the $500 billion semiconductor industry. Now let's look at the numbers from 2020 to 2024. In 2020, it gave a 96% return, the next year 36%, the next year it took a downturn of 13%, and then the next year it gave a turnaround of almost 69% followed by 10%. Even with a slight dip in 2022 during the broader tech sell-off, Cadence has compounded beautifully during the 5-year period, giving it a CAGR of 36%. Now what drives this performance? Cadence sits at the central level of the semiconductor boom. As chips become more and more complex and powerful, the demand for design, accuracy, power efficiency, and stimulation tools is going to skyrocket. And Cadence is one of just 2 major players globally in this space. Its deep integration with all major foundries and fabless chip companies creates massive switching costs. If you're building the next-gen AI, automotive, or mobile chip, Cadence tools are non-negotiable. The company also benefits from long-term licensing deals, high gross margins, and increasing the adoption of AI in its own software stack, which accelerates design cycles and reduces cost for customers. Cadence shows us that owning the infrastructure behind any industry boom can even be more powerful than owning the end product. It's not riding the AI or chip wave for headlines, it's embedded into the creation of the process itself. For investors, the lesson here is clear. Sometimes the most durable growth comes from enabling others to scale. Cadence is proof that tools, not just trends, can build generational wealth. Now, coming to our last stock, which is stock number 5, Palo Alto Networks, the cybersecurity company that has outpaced the market and the hackers in today's digital world. Cyber attacks don't just make headlines, they cost companies billions. And when security becomes the mission critical, one company that keeps showing up at the top of the stack is Palo Alto Networks. Now, Palo Alto is no ordinary security vendor. It has transformed itself from a legacy firewall provider into a cloud-native AI-driven cybersecurity platform that now protects everything from Fortune 500 data centers to remote employees logging in from home. Let's look at how that transformation has paid off for investors between 2020 and 2024. In 2020, they generated a return of 53%, the next year 56%, the next year it took a downturn of 24%, but the next year was even stronger with 111%, followed by 2024 with a 24% return. Its 5-year CAGR remains well above 40%, making it a standout in both tech and enterprise software. Now, what is driving this? Well, this company's strength lies in its evolution. It is no longer just a firewall company, it has now become a platform. Through smart acquisitions and internal R&D, it now offers a full suite of products covering cloud security, endpoint protection, AI-powered threat detection, and secure access services. Its shift to subscription-based recurring revenue has also changed the game, delivering stronger cash flows and better earnings visibility. As more companies shift their infrastructure to the cloud, Palo Alto is positioning itself not just as a vendor, but as a strategic partner. This company shows us the power of strategic reinvention. It didn't stay stuck in its original identity, it evolved ahead of the industry. And by focusing on long-term trends like zero-trust security, AI-based threat detection, and cloud adoption, it positioned itself for sustainable compounding growth. For investors, the lesson here is clear. Sometimes the best companies are the ones that don't just disrupt others, they disrupt themselves first. Palo Alto is a proof that transformation, when done right, isn't risky, it eventually becomes a moat. This was our last talk. Thank you so much guys for watching the video till the end. Subscribe to Appreciate Now because we'll be bringing more such case studies on the global financial markets so that you can diversify your portfolio better.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.